Welcome to this short video, LRP rules. In this short video, I'll cover the key rules regarding USDA's Livestock Risk Protection Program, often called LRP, that you want to know if you're going to start utilizing LRP so that you have a positive experience. Before I started a crop insurance agency where I focus with livestock producers, I used to oversee USDA's insurance products for USDA at the Risk Management Agency in Washington, D.C. In that capacity, I got to travel all over the United States and visit with producers and talk about insurance. The vast majority of those conversations were positive. But if I ever had a negative conversation and somebody who had a frustrating experience with the program, there was a common theme. And that theme was somebody didn't tell them the rules or they didn't understand the rules. And so this video is meant to explain some of the core rules that you want to know so that you have a positive experience. Now, one big caveat, it is impossible in a 10-11 minute video to cover all of the rules regarding LRP. So I'm just going to go over some of the major ones. But before you purchase LRP, you should talk to an agent, you should ask questions that you have so that you fully understand all of the rules. So the first rule, if you're going to use LRP, you must own livestock. This is simple. LRP is not for speculators. It is for those that raise livestock. And it's, in this case, for swine and cattle producers. So you have to own livestock. The second one's actually just as simple. Whatever program you might have utilized from USDA, really since 1985, you have adhered to USDA's conservation compliance standard. And you have to adhere to those same standards if you're going to utilize LRP. The reason is those who follow these standards receive the premium subsidy. Basically, your premium's 35 to 55% cheaper. So know going in that you're going to have to certify compliance with these standards, but they've been around forever. If you've done any program, loan, or any other insurance product, you've already certified to these standards. The 60-day rule is the next thing let's talk about. And this is actually simple. USDA provides a lot of flexibility with LRP. But one thing you have to be aware of going in is if you sell or transfer ownership of your livestock more than 60 days in advance of when your LRP endorsement ends, it becomes void. So just to give you an example, if you have an LRP endorsement that ends June 1st, you can sell your livestock anytime after 60 days before that. So, using rough numbers, anytime after April, you're going to be okay selling livestock or transferring ownership. Now, one of the common questions people have is, well, what if I do an auction and then I actually, put them on a trailer, 6 months later, 4 months later, whatever. Well, each contract can be a little bit different, but in a lot of those contracts, you still have a significant amount of risk. And so in those cases, typically speaking, that 60 days would be from the time that you transfer ownership of those livestock, which would probably be when they're going in a trailer. But each contract can stand on its own. If you have questions, I'd talk to your agent about that. One big thing to remember though, if you do decide to sell more than 60 days in advance of when your LRP contract ends, for whatever reason, there are some provisions where you can transfer ownership to whomever will be purchasing those as long as they're eligible. If that's the case, talk to your agent and make sure your agent helps you facilitate that as well. Okay, so that's a 60-day rule. Just don't sell more than 60 days in advance of when your contract ends. The 72-hour rule. This is simple too. If you have livestock that you've insured that die before the LRP contract ends, you need to report that within 72 hours to the insurance company. That can be simple. That can be sending an email, something like that. I found the companies to be very reasonable when you send them information in, but you've got to send that in to them. One of the things that sometimes I tell my clients if they're not, if they want to not have to worry about 72-hour rule, is simply this: don't insure every single head of livestock. Think about what your normal mortality would be, maybe take a few head off, and then insure that. And then you don't have to worry near as much about a 72-hour rule. Okay, the next one is really a neat one. It's actually a positive step that's just happened recently, and I'm proud to say that I actually helped facilitate this. I was one of the people that went to USDA and kind of testified on behalf of making this change. That's allowing unborn livestock to be insured. Historically, you basically had to have the feet on the ground of the livestock before you could insure them. They had to be on the ground. nowadays you can insure unborn, and this makes sense, especially if you own sows or cows and you know they're pregnant and you see a market that you want to lock in a floor that might bring a profit to you. Now you can insure unborn livestock. Now, there's a few rules surrounding it. You have to actually own the pregnant cows and sows. You're going to have to tell the companies where they're located if the company were to decide to come and verify that. But generally speaking, as long as you adhere to the rules, you can now insure unborn swine and unborn cattle. Proof of ownership. This is vital. If you're going to utilize LRP, first I said you had to own the livestock. You've got to be able to demonstrate that to the insurance companies. Now they're reasonable. A lot of the common things, sales receipts, things like that are going to suffice. And usually when you'd be required to prove this is at the end of the LRP contract, especially if a payment is due. So just know going in that if you utilize LRP, you might be required to show that you do in fact own the livestock and the type of livestock that you have insured. One of the rules that USDA has that's a little frustrating, and I hope they change it in the future. Frankly, I think it's a rule from a bygone era, is you cannot utilize two of USDA's livestock products. The first one that we're talking about today is Livestock Risk Protection. It insures based upon price losses. The other one is Livestock Gross Margin. That was one where it's more for finishing cattle and also for swine, where you're taking into account some feed costs as well. Unfortunately, as it stands today, you have to pick between the two. So if you're going to use LRP, just go in knowing that you cannot use LGM, and hopefully USDA will change that rule here in the very near future. But for now, pick one, and so you don't have a surprise going in the future if you want to use the other one. Also appreciate that USDA is a price insurance product. It's going to protect you if the market falls, but it's not going to provide any protection if you have mortality losses, if you have some kind of a liability issue, or if feed costs go up. It's a one peril program, and that peril is price drops. So just know that going in, that's the only thing it's going to cover. USDA has limits on the amount of livestock that you can insure a year. For cattle, it is 12,000 head a year, and that's actually for feeder and fed. So you could technically insure 24,000 because it's 12,000 each for those categories, and for swine it's 150,000. And just so you know, the year that USDA uses is kind of a commodity year. It's July 1 through June 30th. So 150,000 swine, 12,000 feeder, 12,000 fed. But at any one period of time, under an endorsement is what they call it, you can only do 6,000 feeder, 6,000 head of feeder, 6,000 head of fed cattle, or 40,000 head of swine. So you just want to be aware of that. You have 60 days after your endorsement ends to make a claim. That's not very hard to do, and it's something that most people will not have any issues with, because you want to get your money if you're doing anything. But just be aware you can't sit on that. So after the period is over, you have 60 days to turn in the required documentation for a claim. It's also important to know that USDA has the right to audit you, and really you have to keep your records for about 3 years from the period of time that your coverage ends. And so just keep a hold of those records if you are ever audited. Now sadly, and I know this last one's going to break many of your heart, perhaps turn you away from LRP, and certainly ruin your best laid plans. But if you look deep in the LRP policy, you cannot pay your premium with livestock or a commodity. In other words, if you were considering using LRP and then paying your premium by bringing a steer or two into your local insurance agent's office, or perhaps the insurance company, you should know going in, unfortunately, that is not going to be allowed, and that is in the policy. And I'm glad I wasn't the agent that had to test that theory out when that happened. Okay, so those are the key rules with LRP. Again, you might have some questions on your mind right now. Feel free to call me. My number's on the screen. I'd be happy to answer those. We have some great agents that know LRP inside and out. And our goal when we work with clients is to avoid surprises. We try to tell you everything up front so that you have a positive experience with the product. If you like this video, please subscribe. If you have questions, feel free to call us, email us, or you can put in the comment section of this video. We appreciate you taking time, and have a great day.